Welcome everybody to our next webinar here at JFT Brokers. A warm welcome in the name of JFT Brokers as well. My name, as always, for those kind of webinars, Stefan Friedrichowski. I know it's a real complicated last name. But anyhow, just call me Stefan if you have any questions. If you want to get in touch with me via email, you see already my email address here on the first slide. And if I talk about slides, as always, you can download the slides of today's webinar directly via the GoToWebinar control panel. And then you have direct access to the slides as well. Later, I will show some Excel sheets. If you have interest in those, just send me an email and I will make sure that you will get those Excel sheets directly. A few other remarks here today, because I see a lot of new names. You find the recordings of the webinar on the JFD YouTube channel from tomorrow morning onwards. And as well, all the other webinars of my colleagues in French, in Italian, in German, you find on the JFD YouTube channel as well. Interesting topics, different speakers. So yeah, it's a big bundle of recordings. That's true for all of us, and with a strong history up to now. The topic today, a purely statistically derived trading strategy. That sounds strange. And indeed, you may call it a little bit weird. I know that. And later, the one or the other may say, oh, I don't see charts, I don't see resistance lines, something like that. No, exactly today, you will not see anything like that. You will see indeed some math, and we do some statistical analysis of different underlyings. And out of that kind of analysis, we can directly derive a trading strategy. So I know it's not the usual topic. It's, as I mentioned, a little bit weird. And I have to admit the idea behind that kind of strategy, and indeed doing the math, the calculations of that, I have done in my hammock. That's my favorite place in the evening. And then I had an idea, and I took a pencil and wrote down some equations. And finally, I got a strategy. And I will share with you that funny document later during the webinar. So maybe you enjoy it, maybe not. Hopefully you do. Otherwise, you find a lot of other pure normal kind of strategies in the recordings and on the JFD YouTube channel if you are interested in more specific trading strategies. I would like to announce already that in 2 weeks we have something really special. Then we will talk about the JFD Basket Investor. That is a bundle of strategies. We go through them and you will see. Then you have something in hand. You can even follow directly via JFD. And I will go really behind the scene to tell you what's within that basket, what in the portfolio, and how to set up a portfolio. You will learn during that webinar as well. But that's in 2 weeks from now. Okay, as always, I have to show one time here that with disclaimer, because we talk about trading strategies, but finally, when you trade, you always trade on your own risk, your own responsibility. That's, I think, obvious and self-explaining. So I have done that as always. So in detail, the topics of today, since we go in some equations, and I want to have a little bit of motivation first, and I will, next slide is already the equity curve of the strategy. It's 3 weeks ago that I derived that strategy. Now I have results already, traded results for 2 weeks, and I will share them. It was a little bit of an experiment to announce something here in the webinar, not knowing already the history, and I don't have a backtest. In this case, I don't use any backtests. I just trade, and I do it automatically, but you will see how it will run, and the results are positive. Yeah, that's what I wanted to achieve, but you will see. So the basic idea has to be pointed out a little bit more in detail, and principle that is already said. Now, it's a long-short simultaneously strategy. So indeed, we open two trades for one underlying, one long and one short trade, and we will manage those trades independently. And what sounds weird that you do something like that, long short, at the same time, you will see it will be profitable in this case. And the basic question behind which it should be answered first is, what is a typical price move of a specific underlying after some X minutes? So how far can a price from now in 5 minutes, 10 minutes, 1 hour, 1 day move typically? Because that universal line will be the input for the later to be done equations and calculations. So the price movement is something which we use here, and there is a typical price movement over time if we disregard the direction. If we do that and we know that kind of behavior, then we can pick the right underlyings for that specific strategy, because we need underlyings which show strong moves, fast moves. And there are a couple of those, especially all related to Japanese yen, for example. But later you will see there are two even better. And those one will be, that's the best one for that kind of strategy. We trade. And if we trade, we need targets, or so to say, take profits for any trade. And how to determine that take profit level, we really do pure by math. We do something like an optimization or finding a maximum of an equation, and that will tell us indeed where to put the take profit level of any trade. And that's one of the key aspects here, to find that level. And we, in this case, it's not just saying, oh, let's go for a stop loss, take profit level 1% above for a long trade, our entry point. No, it's something which has to be optimized, but pure applying math. And since we enter trades, we need a stop loss as well, as always. No trade without stop loss. And we do later trade sequences. So we open a long and a short trade simultaneously, and of course only one of the two can or will hit the take profit first, and the other one is in the minus. So we have to manage our losing trades, so the ones who are in the minus, at least temporarily, and therefore we determine a so-called rebuy level. So we do something which is, once again, a little bit weird. We even rebuy in a loss, but still, if we have a stop loss for the overall trade, what I could later call trade sequence, then it's okay. Then you can do something like that. But you need a stop loss, and that is something really necessary, as always. And finally, I show it directly in an MT4 how the strategy is running, and then you will even get more feeling about that kind of strategy. As I mentioned, for motivation first, here the equity. So as I mentioned, it's a little bit 3 weeks ago, I started with the calculations, and a week later, I was already able to put that strategy live. Live in this case means a demo account. Of course, I always start with demo accounts when I develop strategies. And what you see here are the first 14 days of that account. So in total, 800 euros, and that was profit. That was yesterday at 10 o'clock German time. You may think about the number, or you may remind that number 800 euros, because later we go directly into the account and then we compare what has happened since yesterday morning. You see, already there are a lot of underlyings traded, and we have a perfect increase in equity. So monthly growth up to now is 1.8%. If that goes on, it will be a fantastic strategy. It's trading a lot. That is something which is specific for that kind of strategies, because you will see and learn that to take profit is extremely tight for any trade. So it looks good. It looks promising. Let's go into more details. So as I mentioned, when we start any underlying, we open two trades, one a long and a short trade, and on the same underlying. So now we have two basic questions. Trades need to take profit, and we need that number. So we have to calculate. In this case, we have really to calculate that kind of number. I will show you on what basis we are doing that kind of calculation. If we have a loser trade, we need a rebuy to recover. It's not martingale. It's a little bit like a grid strategy, but if you do it with a final stop loss, even if you increase your position size, then everything is okay. What do we trade? We always trade 0.02 lots in this case. And that has a specific reason why I not go for the 0.01. It's a little bit related to JFD. You know that we have a standard commission of 5.5 euros per traded lot, but unfortunately not if you go for the smallest unit, which is 0.01 lot. Because then you will see you have a commission of 0.06 euros, so 6 cents. And since that strategy suffers from any costs like commission and spreads, we have really to do the optimum. So minimum lot size here in my case is 0.02 instead of 0.01, simply to save that €0.5 per lot traded. So that's the only reason. Otherwise, I would go in units of 0.01 lot in this case. So that's the principle of that kind of strategy. But now the question is, how far is typical price moving after X minutes? And to tell you how I get those numbers, what I did is simply I downloaded historical data, M5 data, with a history of 14 years, so really a long history. In numbers, that means it's about 1 million candles. So it's a huge number, so that's real statistics. And now what we do here is simply that we go to some point in the history, and then we ask, how far is the price moving after 5 minutes, 10 minutes, 20 minutes? And we disregard the direction, so we take the absolute price change in percentage. Let me go to a chart here to illustrate a little bit what I'm doing. And by the way, that will be the account we will have a deep look into, because that is a basket of JFD, and we will look there later. Later means in 2 weeks from now. You see open positions, but that's not the topic of today. What I try to derive first is the question, how far is the price moving after X minutes? So once again, how I did that. I go to some point in the history. Let's say I go here to that candle. You see my mouse cursor. And that is the close value of that candle. After 5 minutes, the price has been here. After 10 minutes here, after 15 minutes here, and so on and so forth. So that's the logic. And then I calculate everything for that point, then for this point, 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 and then I average over the complete history. So always taking an opening point and then looking after 5 minutes, 10 minutes, 20 minutes, 40 minutes, and so on and so forth. And then averaging over the 1 million candles. So what do I get? I get the complete average over time. So I get not the time meaning years, year 2001, year 2010, and so on. No, the average, and you will see the results here. It's a big table. I did that investigation for 28 forex pairs and additionally for gold. And that's a strange symbol, I know, but that's the way where I get the data. That is a DAX, which is here called GRX euro. Indeed, this is a DAX, but that my data source uses that symbol name. Anyhow, so you see a big table. I know it's complicated. I show you the graphs, it's easier, but that you see the logic behind. So for some calculations later, I need the exchange rate for a specific symbol. The overall average, the average means in this case over 14 years. And then here you see those numbers. That is the percentage, the average percentage change after 5 minutes. This one after 10 minutes, 20 minutes, and so on. Visually, we get that kind of graph. So what you have here is the price move in percent after X minutes. And that's the average over the last 14 years for different symbols. Let's start with the first one here. You see that one is exactly the DAX, showing the highest movements versus time. So if you ask which underlying is moving the most or most far, the answer would be DAX. The next one would be gold. And then it would be a New Zealand dollar, Japanese yen, and so on and so forth. You see that square root-like behavior. You see always the curve starts very steep and then it flattens over time. That's indeed something which is to be expected here, and people who have seen already other webinars of mine know that if you describe that typical price change versus time, you can find that square root behavior, and in case it would be a perfect square root, and I fitted here already one of those, I would forget which one, but I think it was, euro, US dollar. And you see that we have an exponent which is 0.5 and a little bit more. If it would be 0.5, then it would be an indication of a perfect random behavior, because a random walker, a random movement, would have an exponent of exactly 0.5. That we have a little bit more is good, because otherwise it would be the first proof, not the final one, but the first proof that price movements are random. And if it would be random, we could not trade, because randomness you cannot be overcome. So you would have no chance by trading at all. So that's a good thing. That's not the perfect square root, but we know that now that the typical price movement. And we know it for every underlying, and we need later exactly that kind of functional behavior for our calculations. So we, up to now, please remind, it's like a square root, and the fastest moving underlying is a DAX, followed by gold, and then some Japanese forex pairs. So that's the first step. So we know when we start looking to from now, we can expect fast movements during the first couple of minutes, and then it will flatten later. That's something we have to keep in mind. Let's do the next step. because we need that input now for the next step. Because what we now try to do is we want to try the right target for our long-short trades. And you see already something here handwritten, and I put it right that we can read it. But that was really what I have done on my hammock, and when I derived that kind of and developed that kind of strategy. Let me really start with this mess. I know it's not something most famous for many people, but in this case, I will do it, and I hope you find it not too boring. But it's a central behavior for that kind of strategy. What we can say is we know that the price is moving like that square root behavior. So we have an A times square root of time. But as you know, when you open a trade, you are instantly in the minus. And that is meant with that G. It's a little bit German here, stands for Gebühr, which stands for costs. So we have two kinds of costs immediately when we open a trade. We have spread and we have commission. Both we have, and every trade is instantly in the minus. Meaning if we open that long-short combination, we are even double in the minus because both trades have commission and spreads, and that is already the minus. Let's think a moment that this behavior, this time behavior, would be the only and everything, and no direction. That would be the price versus time whenever we open a trade. Exactly. What does it mean if we translate now the profit of a trade versus time? So we would have at time 0, we would be exactly at minus G because we have opened our trade and we realize our costs, spread and commission. With ongoing time, we would reach more and more profit. I know, only if we are in the right direction. But let's assume we are in the right direction. And then we have that equation illustrating the profit of the trade. It would increase with time, and we would start in the minus at time 0. Okay, that is a profit after a certain time. If we now say, okay, after a certain time, we close the trade. In this case, it would be profitable trade if we are already above here 0. If we wait a little bit more than some time, then we are already profitable. But what if we now calculate that we close a trade after T0 and then open directly the next trade? So think about how many trades do we do the day. It would be exactly 1,440, because that's the number of minutes per day, divided by this T0. Because after T0, we close our trade. This is something like the frequency. So because we close the trade after T0, then the number of trades per day would be 1,440 divided by T0. Since we want to calculate the profit per day, we have to multiply this one with the profit of a single trade. Good. So now we can insert that equation here, the profit of a single trade, into that equation. So we put it here, and you see the result here. And if we multiply, then we have finally this as a profit per day, assuming that we are always in the right direction. And for the loser trades, we care later. But we have now an equation which is related 1 versus square root of time minus something like 1 divided by T0, just by multiplying that equation. So that is the profit per day for that kind of, let's call it strategy or semi-strategy, because it's assuming that we are always in the right direction, which is not true, I know, but we have to manage that later. If that is a profit per day, and now what comes next is, as always, as trader, we want to maximize our profit. So what we try to find is when to close a trade. And that means at what level, what should be our take profit level for that strategy. In order to maximize our profit per day, now it comes to what you have learned at school. Take that equation, derive the first derivative. We do the derivative versus time and set that to 0 because we want to find the maximum of that equation, the profit per day. Doing the first derivative here, setting to 0, and then solving the equation is straightforward. We can calculate the time when we reach the best level, and that would be something like 2g divided by a then square. And if we put that number into our first equation, then we get our take profit level. And that take profit level is surprisingly exactly G, which means the take profit level for our trades should be exactly the costs. So that is interesting. So the best take profit level for that kind of strategy is exactly the cost itself. So we open a trade, I know, then we are in the minus, but the take profit for that specific trade we would set exactly to the costs. Let's do it a little bit more practically. Just already in a table to get those numbers ready for our trading strategy. I have another table here, and what I put here already into the table, those investigated underlyings, the forex pairs, and additionally DAX and gold. Then I put into calculation here the spreads for all those underlyings, and that are typical spreads. It's not the best spread, it's more a typical spread. And then I did my math here already in order to calculate my spread for a 0.02 lot trade for all forex and gold trades. The only one I calculated a little bit different was the DAX, because for DAX the minimum lot size is 0.1 lot and the commission is different. The commission for a DAX trade with 0.1 lot is just 2 cents. So you have here one column with all the spreads already in euro, and then the commission. That means we can add up those 2 columns, and then we have our costs for the applied lot size. Forex 0.02, gold is the same, 0.02 lot, and DAX is 0.1 lot. And you see different numbers here. It's always spread plus commission. Commission 0.11 euro for all those, because we trade 0.02 lot, and that are our costs per trade. But it's not only the costs, it's already the target. It's a take profit level which we later use during our trading activities. So that is simply exactly the level for our take profit. Opening the trade, then setting the take profit at those numbers. Of course, you have to recalculate for the different underlyings, but here we have the numbers always in euro. So that is the number which should appear if you go in the chart and look for the take profit level for that trade. So first step is done. We know where to set the take profit in order to maximize our profit per day. Good. That's the first huge step. But now we need something else, because we know it was a little bit ideal. I took those, up to now I assumed that my price change, that I'm going always in the right direction, and the price change would exactly follow that line, but I only know that that is the average disregarding the direction, but that is a typical behavior overall. So we have loser trades as well, because we open a long and a short trade simultaneously, and at least one is a little bit later. When the first one hits take profit, the other one is definitely in the minus. The idea now is that we do a rebuy. That is something which you can only do if you still have a stop loss. But now we have a question: where to set the rebuy level? Where to say, okay, loss is enough. We should rebuy in order to get a better average entry price. If you do something like that, then you first have to say how much money are you willing to risk for that kind of trade sequence. I call it trade sequence because we open a trade, the trade goes into the minus, and we do a rebuy. And those two now are a trade sequence. And we do a second rebuy, and the third, and the fourth, and so on. Still, we need a stop loss level, and that's key that we do it. And in this case, I simply said, okay, I'm willing to risk 1,000 euros for any trade sequence. What I need now is, I have to change that symbol here. I have to say, since I do those rebuys, step by step, if the price is going totally to the wrong direction, then I do rebuy. I need something here to do that kind of calculation. Where to set the rebuy level? And I said, okay, I'm willing to risk 1,000 euro, and I want to survive a total price change of 2%. And since I do everything here on a really small time frame, 2% is already something. It's not quite a small value, but it's not a real huge value. It's something in between. And now I want to calculate that rebuy level with those two numbers, having in mind I'm willing to risk 1,000 euro, and I accept a price change of 2% in the wrong direction until I want to hit my stop loss level. To do that, we do a second step just in Excel. It's not complicated, and it's a little bit illustrating what we are doing here if our trade is going to the minus. What I have done here is the following. I simulated a price change. So I started with something which is at price level 1. Think that would be euro, US dollar, I don't care. Anything like that. And that price is constantly going down, as you see, but in very small steps in this case, because I want to do it quite accurately. Since I open here virtually a long trade with 0.02 lot, you see, okay, I have already costs for that trade. In this case, let's change it to, let's say, 0.4 euros. And I'm instantly in the minus. So my total costs is there. Therefore, when I open the trade, I have a total loss when opened already of 40 cents. So now my trade goes against me. So price goes down. I have a long trade. Price goes down, down, down. And now the Excel sheet is done in a way that I have here a loss trigger. So you will see I go down in the Excel sheet. Somewhere I reach my rebuy level. And that is here. You see, at that point in time, my loss was already 2 euros. And I do my rebuy. So I buy additionally 0.02 lot long. Instantly, I have costs, and now it goes further. So you see what happens. The rebuys will occur more and more frequent, as you see during I move here down. And finally, I get something like this. And now you can clearly see how I derive my loss trigger, my rebuy level for those trade sequences. You see, if I would do it like this here, I would rebuy in case of a loss of €2. Then if my price goes finally 2% against me, then my total loss would be, whoops, nearly €30,000. That's a lot. So in order to survive this kind of rebuy level, I would need a stop loss level of nearly €30,000. That's too much. So let's do it different. I increase my rebuy level, and you see what happens. If I don't, if I will rebuy at a higher level of €3, then my total loss here goes down. And what I did is simply I went through that Excel sheet, and that was only because it was faster to do it by Excel than by equation. In principle, you can do that job here by equation as well, because that is the square root behavior of the total loss within those 2%. And you see what happens if I go for a rebuy level of €8. So if I wait always €8 additional losses before I rebuy, now I can survive with my €1,000, a price change of 2% in the wrong direction. So that gives you already a number. Think about charts looking to movements of more than 2% in one direction. They will not occur that often without recovering in the time between. And that's what we use here for that kind of strategy. But you now see we can clearly derive that rebuy level for a given number of costs. And in this case, I think the optimum number would be something like this here. €3, 73 cents for 0.4 costs per trade. If I change the costs, it does not really change the picture heavily. So that kind of curve does not depend strongly on the costs per trade. So one could take those €8 for each underlying. But I did it a little bit more mathematically. So I have that kind of rebuy level specifically related to the cost per trade. I put all those numbers, once again, already in my final Excel sheet. But we are not through. One step is still open. So you see here, I put already all my rebuy levels for the different underlyings in that column. And you see those numbers do not depend strongly on the cost per trade, which are different per each underlying, but we don't need that much change for those rebuy levels. But now the question is, why did I highlight those 8 symbols and put them exactly in that row? And the answer is, since we did something more by calculating the maximum profit per day, we know something additional. Let me go to my handwritten paper here once again. And you see finally here in the very end of the page, I calculated the profit per day, and you see it's related something like A squared divided by G, which have been the costs. So what does it tell you, that kind of equation? It tells you the profit per day would be maximum, or would be higher if the costs per trade go down, that we expected. Lower costs is higher profits, as expected. But you see something else. We have that A square. What was A? A was the one which describes my is a prefactor from that square root behavior versus time. So what is telling me? The more strong my price change versus time for a specific underlying is, the better is my profit per day. That's good. So let's find out exactly that A. for each underlying. So we need that A in order to find the best underlying for our trading activities here. But that's easy. So, we have already the table, typical price movement versus time, and we know we have the typical square root behavior. But we need to find out that number, that prefactor. How to do? Quite easy. Since we know it's a square root behavior, we simply square those numbers. You see what I have done here in the Excel sheet? I squared all those price changes. And if you do so, and now once again you build a graph of that squared price change versus time, you get those straight lines which go through the origin, and they are straight lines. The reason is because we are extremely close to that square root behavior, and now the slope here is exactly A, the one we want to derive, that number. So squaring and then simply calculating the slope directly here in Excel is straightforward, and then we know for each underlying the prefactor A. For trading reasons, we have to apply the exchange rate, but that is something, let's say, more in detail. I took all those numbers of A, put them into my table, and then I'm done. You see, I put those A's here into the table, and then I calculated A square divided by G, because that is indicating which one has the best profit per day. And then I sorted my overall list exactly along that value. The higher, the better. Yeah, now you see why I go for DAX, gold, and so on and so forth. Because those promise me the highest profits per day. Now back to the trading activities. We open a long and a short trade. We set our take profit level like this one, directly calculated by knowing the spread of a specific underlying and knowing the commission for a specific underlying. That is a take profit level for each trade. And then we know for our loser trades where to rebuy in order to get or try to get those trades finally being winning trades once again. And that's how it works. I think it will be a little bit more obvious if we now go to live trading. And live trading is here that account. I will explain once again all aspects of that kind of strategy, but let's first get the overall picture here. First thing, since we are trader, we are keen to numbers. Yesterday morning, 800 and a little bit. Today, right now, 936 profit. Wow, not that bad. So a little bit more than 100 since yesterday morning, and that is indeed the average number here, what we can achieve. You see a lot of funny lines here. Any line, any straight line in a chart is illustrating a trade. A green line is a winning trade, a red line is a loser trade. Let's start with something maybe a little bit more obvious, hopefully. Let me start with a DAX chart here. So let me zoom and still see both levels. So it's a long time ago that we have opened here at that level, and it was here in time. At that point in time, I opened a long trade, and there has already been another short sequence. So therefore, I did not open in this case still simultaneously. That kind of opening the both trades simultaneously is only at the very, very beginning, when you really start that kind of activity. So what you see here, I opened here a long trade, And unfortunately, up to now, I have not hit my take profit level. There was another trade sequence ending here, and then here is still a short sequence open. That short sequence may get in take profit, hopefully now in a minute. Now we got it, and you will see in, let me see, oh, it will take 40 minutes, 40 seconds. In 40 seconds, because everything is running here on an M1 chart, in 40 seconds, strategy will open a new short trade. And right now, we can directly see the loss of our DAX trade, because here you see we have a long trade running, 0.01 lot, and that trade has right now a loss of €6, which is still below the rebuy level. So if the DAX would go a little bit further down, then we would see directly the rebuy of a long. We are already long here, and if we would hit that about €8 for that loss, then we would rebuy the long. Now you see we opened a new short trade, always at a given minute number, and now maybe already in a few seconds that short trade will hit already the take profit. You see the levels originally are extremely tight, and maybe even during speaking we will realize that that trade will come to its take profit level. That's how the strategy really works, and it's quite easy to do something with an expert advisor, which is done here, to have that strategy up and running. And let's look a little bit about the downside of such a strategy. You can immediately realize what is the downside. The downside is always if an underlying goes more or less straight in one direction. We will get some winning trades during that sequence, because we go into the let's assume we something goes strictly south. Of course, we have always those small winning trades going south, because we open short trades as well. But our long trade is getting more and more in the minus. The rebuy we are doing will increase our risk, but still we have a stop loss. And that's good to have that stop loss level. Originally, that stop loss is really far away. But when it comes to bigger sequences like this one here, Euro, Japanese yen, right now, let's go into that one a little bit more bigger here. So then you see already, oh, there have been already lots of rebuys. Buy. So now it's time that the price, at least temporarily, goes to the north, reaching that take profit level here as well. So if an underlying goes straight in one direction, finally we will hit our stop loss level. But if it's only wiggling around, and the good thing is most underlyings do it, that's what you normally, when you trade, find not that good, that prices going up, down, and you are always in the wrong direction. For that kind of strategy, that behavior is perfect. Long movements in one direction, like here in Japanese yen, they are a danger for that kind of strategy. But still, we have a stop loss. And you see, after about 2 weeks, I gained already €1,000. At least I can now survive one stop loss level, which would be okay. Then I still would be slightly in the plus if it would not happen during the next couple of minutes. But if it would happen tomorrow, definitely I'm still okay. So that's how the strategy works. And you see that different, or you will see just a second here. Um, Let me refresh that picture. So now we are at 936 euros right now. And I trade a lot of different symbols here. Um, and I changed the philosophy finally to my Excel sheet. Therefore, there are some underlyings which are not traded anymore. And at least for the last 2 weeks, you see best results: British pound, Japanese yen. Second is gold. Third is DAX. It's not exactly the order like my Excel sheet, but maybe those 2 weeks are not already statistics enough. But anyhow, it's exactly going into that kind of direction. Yeah, the best one would be around Japanese yen, DAX, and gold. And that's already confirmed here. You see euro, Japanese yen. This one is something different, and this one as well. But it's already going into the right direction. So it's a real weird strategy. And no backtest, just derived by math and nothing else. So that's how it works. And I think you got it, how it's done, and how, if you finally do a strategy like this, how you can calculate everything. And the good thing here, and honestly, this is the first and only up to now strategy which I derived totally without a chart, just as an input, costs per trade, and knowing what is typical price movement. Yeah, you may call that it was the input of a chart. You're right, but that is simply statistics doing or deriving that typical price change versus time, and we need that in order to calculate which underlyings would be the best for that kind of strategy. So in a nutshell, we know the price change versus time is something close to square root, and that's the base for that strategy. We know which underlyings move strongest: DAX, gold, Japanese yens. Those are the one which move more strong than any other. And now we calculate the take profit level out of that, out of the costs, and we calculate the rebuy levels exactly out of what we accept as a maximum loss within a typical maximum price change. Those two numbers, the 1,000 euro and the other has been the 2%. Initially, when we start, we open a long and a short simultaneously. Later, you will see one goes into take profit or maybe stop loss. And then a minute later, I open simply the next short or short, which one has hit the take profit level before. So then I talk always about trade sequences, and those trade sequences are managed independently with stop loss level and take profit level, and everything is always for a complete sequence. So the take profit level is always meant to all short trades or all long trades. Same for the stop loss. So we have always only one take profit for each direction. Those trade sequences are managed individually, and that gives finally a very interesting equity curve. Let me see what happens with that strategy during the next couple of weeks. I still will run it. I will report on that. You can be sure. And yeah, the real funny thing about that overall strategy: pure math, pure statistics, no chart, no resistance line, no EMA, nothing. Nothing like that. Price only. That's all. I hope you enjoy it. Even something really weird like this one here. Next time, we will talk about the basket investor and how to manage a portfolio of strategies. So I not only want to report about the basket investor itself, also the logics behind. So that's always possible to learn something, how to manage risk, how to set up and create a portfolio. If you have more strategies than one, then you have to care about something like that as well. So that we will learn in 2 weeks from now. But once again, please look to the JFD webpage. You find a couple of interesting webinars from my colleagues as well. I know that there are great webinars, totally different topics always, and so you can enjoy those as well. And you can find all the recordings on the JFD YouTube channel. If you are interested in Excel sheets for which I showed today, just send me an email to s.friedrichowski, really complicated, I know, at jfdbrokers.com, and I will make sure that you will get those Excel sheets already tomorrow. That's from now. Enjoy your time, enjoy the evening, and hopefully see you next time in 2 weeks. Bye-bye.